Hello ladies and gentlemen, and welcome to our webinar today. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's webinar will be the first of this month's webinars with regards to fundamental analysis, and all the 5 topics until the end of the month are connected. I will just let you know what to expect. Today's topic will be the first steps and the economic calendar and its understanding among traders of the fundamental analysis. We will have a look at the key fundamental factors the next time. The time after, FX fundamental analysis. After that, commodities fundamental analysis. And at the end of the month, we will have a look at how to measure currency strength. It's also an integral part to the fundamental analysis, and of course with connection to technical analysis. This is more of a short period to long period type of analysis, how to measure which currency is stronger than another. Of course, more details we will have a look at the end of the month. First of all, I would like to mention that these particular series this month, we will cover them one more time, as well as we did last month, due to the high interest to those particular series. As I understand from all the feedback from you guys, those that are trading with us, of course, all the feedback that you are giving us, you're mostly interested in more of a fundamental side of the market rather than the technical, simply because what the market is moved by these days is mostly by fundamental news. Therefore, we will cover the particular topic one more time this month, and of course the month after you can expect a brand new webinar series, as well as for the month of August. They will pretty much be something in between 1.5 months, with a 2 weeks period of a break due to some of the holidays that we will take here in the company. But you will see the schedule next month. So today, firstly, we will have a look at what is actually fundamental analysis, and what is the economic calendar in general, and of course a little bit in more details of what the traders are looking at, how they understand it, and how they should understand it. The first thing is to mention that the fundamental analysis in the financial markets is a type of market analysis which involves studying of the economic situation of countries to trade currencies or commodities or any other instrument in our platforms more effectively. It gives us information on how the big political and economical events influence currency markets. In general, when we talk about currency markets, please understand that I don't have to repeat every time currencies, commodities, indices, company shares, or any other traded instruments. So sometimes I will only focus on the currency market. Basically, the general agenda is to all traded instruments. Of course, we'll break it down to 2 main topics, as the FX and commodities. That will be our next webinars. And figures and of course statements given in particular speeches by important politicians and economists are known among the traders as economical announcements that have a greater impact on currency market moves. In particular, announcements related to the United States and its economy, and of course politics, are the primary to keep an eye on. Now, for those that are exquisitely following the market each day and the economic calendar in general, you will find out that there are numbers and numbers. So sometimes numbers meet the expectations, sometimes they exceed it, or not so much. Basically, what is important to remember is how this particular event will affect the market, and most of all the particular currency pair or instrument that you are looking at. If we're of course looking at in general for the United States, as our main focus, of course, you will find that most of the traded instruments out there with high volatility are connected to the USD, or in general to the US economy. Particularly when we're looking at a fundamental analysis, first of all, we have to find out what kind of analysis we want to make. And of course, the period of this fundamental analysis, whether it's going to be weekly, monthly, quarterly, or annual. Of course, as basic fundamental analysis, you can make weekly fundamental analysis because day-to-day news trading is more of a calendar-orientated type of trading, the so-called news strategy trading. And of course, we have it as a webinar as well. For those that are particularly interested in these, we spoke about two different types of strategies, with a little bit more advanced and one which is quite basic. For those that are actually focusing mainly on the breakouts on support and resistance levels. And of course, the one that it's a bit more advanced is the one that is actually focusing on the inter-candlestick, which is with the direction and the funneled with the correction of the market, so you can better take perspective on market direction. And take, of course, the better price is what our focus is. That's why this particular strategy of news trading, as we presented it before, some of the attendees here might also confirm that. We've been focusing mostly on news trading, but from technical perspective and market pricing. However, when we speak about fundamental analysis, it is not as easy as it actually sounds. You don't only have to look at the economic calendar. There are more events, especially within reports in separate news agencies that are delivered. You might find information that is particularly interesting and most of all heavily impact on the market. So fundamental analysis is the examination of the underlying force that affect the well-being of a certain economy, industry group, or a company. A company, when I mean a company, that means, let's say, Apple as a company, Google, for instance. Should you take any other out there that have an index, or it's represented within an index as the S&P 500, for example. If there is a some kind of a manufacturing company, it will be in Dow Jones Industrial Average, so on and so forth. I don't need to give you more examples. I'm pretty sure you're sophisticated enough to come up with these solutions by yourself. As with most analysts, the goal to derive a forecast and profit from future price movement. A level of fundamental analysis may involve examination of financial data. Not may, but in most critical points, it does involve examination of financial data, management, business concept, and of course, competition. It depends on different industry, of course, whether it's non-agricultural or manufacturing or non-manufacturing. It depends on what you are trading. If you are actually focusing on the basics, or you are focusing on a particular country so you can trade its currency, you will most of all focus on the most important news. You will not focus in general for different separate companies, their earnings, or their annual, should we say, reports where they have job reports, how many people they've fired, how many people they laid off, how many they've hired, what is their particular average rate of hiring people that will derive to their earnings. So in general, companies are actually relieving people from duty, let's put it this way, in order to save from earnings. So if they have low income, they will of course have to either close a few branches, or if they don't want to do that, they have to cut down the working force in order to save some additional funds for the future. Otherwise, they will go bankrupt if they don't do that. That's one of the major events that is actually influencing a certain company, as well as this one. You can move it to a country where we have, for instance, in US, you have the non-farm payrolls, which have the major impact over the market, as well as this, of course, influence the timing of an interest rate increase, and in general the mood of the central bank, in particular the Federal Reserve in US. But when I'm speaking about the US economy, ladies and gentlemen, just focus on the fact that this is the largest economy in the world. But in general, you can transform this information into analyzing other financial markets, like the European market, the Asian market, if you wish, South America, if you want, or any other particular markets that you would like to focus on. So to forecast future price movement, fundamental analysis combines economic, industry, and company analysis. This is what we've actually summed up to derive to its particular current local currency value, and should we say fair value, to forecast future variables and future price movement. Price movement, I would say future currency direction. But what you have to always have in mind is when you are trading a currency pair, it suggests that you are trading both currency parties, the one which is underlining and the one which is actually the secondary. It doesn't really matter, but you are trading two currencies, one against another, as well as, you know, when you buy one of it, you are automatically selling the other one. So you have to always have a look at those two particular countries. If you want to focus in the most traded currency pair out there, this is the Euro USD. At the moment, the euro is actually falling, but not particularly because the dollar is strong, but most of all because the Eurozone is in a very bad situation, especially as you are probably following the news. It's about the Greece debt, the inavailability of the government to reach a deal with the IMF, especially with today's standoff from the conference table of the International Monetary Fund. They've actually pushed the pair even lower. But you can actually compare this, the dollar itself, with other currencies, and you can pretty much see that the yen is actually much stronger right now against the dollar. And this is not because the dollar is weak, but it's because the yen is stronger. You see, when you're looking at to make a fundamental analysis, you have to take all variables. That's why this is the place to mention that our final webinar is one of the most important, but not that every other one is least important, but it will give you a much better perspective to find out what exactly you should look for. So basically you have 8 different currencies, or 7 different currencies. 6 of those are actually compared one against each other against one currency, in order to find out which currency is stronger, which one is the weakest, so we can pair them up for the time period that you would like to make that analysis. Now, the general steps to fundamental evaluation, even though there is no one clear-cut method, should we put it this way, there is no shortcut. A breakdown is presented as into the economic calendar. This is our next chapter, what we will have a look at. Let me just position a few numbers here. We're going to have a look at yesterday's announcement of the US economy, the one with the major impact, where we saw most of the currencies versus the dollar slide slightly, of course, not majorly, but this is the retail sales that came out with 0.1% higher than the expected numbers. But this is the point where actually I have to let you know that the most important number is not what the consensus suggests. This is pretty much what is the investor's expectation, let's put it this way. This is something that can drive the currency pair in a direction prior to the release of the news. But what will actually set the currency pair's move for the time being would be the comparison between the current release of those numbers against the prior. And as you can see, we have 1% increase since the past month. So what does that tell us? For month of April, we have 0.2% numbers for the retail sales. For month of May, we had 1.2%. That's 1% increase for 1 month. That's very good for the economy. But on the other hand, when you see last Friday's announcement on the non-farm payrolls, they came out 280,000 with about 55,000 higher than the consensus, but also came out with about 65,000 higher than the previous number. So what does that tell us? That tells us that the job market is improving, but that doesn't mean that we can't have a little bit of a slowdown. You know, this is a moving average. All of these numbers, if you present them in a historical time value, you know, for those that are actually familiar with geometry or any kind of mathematics, you can pretty much do that on a piece of paper with a pen. You can just draw X, Y, Z on the as a diagram, put those numbers on, and you will see that this is a constant curve represented. This is a moving average. So when you have a peak, you have to have a drought or a little bit of downside before the next upside movement. It's very rare that we can face a constant 45-degree stable flat line. This is something that we can expect in a normal trend, but still the moving average is not a straight line, obviously. So when you put those numbers there, you will find out that the yesterday's release on the continuing jobless claims, they came 2,265 against 2,188 from the previous, and the on the consensus, of course, and the previous was 2.222 on the previous month. So that tells us that not only the numbers are worse than expected, but they're actually worse than previous week. That's from the last week. Also, that same thing applies for the initial jobless claims, higher than expected with about 2,000. Not much of a change there. I mean, if that number was higher than 280,000, then it would have been bad for the economy itself. So what I'm trying to show you here, ladies and gentlemen, is that when you're looking at those numbers, don't only focus on the red and the green in the calendar. This is not going to tell you the direction of the market. It will only point you on the short-term movement. When I'm speaking of which short-term, that's within the first 4 hours of the release of the news. Afterwards, the trend is particularly over, and then the currency pair continues on the route where it has to go. So, for instance, let me find another number here, which has the particular sense that I'm actually trying to show you here. Let's take the house price index for Canada. It's the release from yesterday. Or no, let's say the industrial production for the Eurozone today. Now, what we saw for the industrial production is 0.1%. The consensus was 0.3%, but the previous number for the previous month is -0.4%. So we actually have 0.5% increase. 0.5% increase in the industrial production. that is not necessarily bad when you see the red numbers in there. It's just telling you that it's missing the estimates of the economists, which means that the survey that it's made by whatever agency that is delivering this particular consensus numbers might be accurate, might not be accurate, but you shouldn't focus on that. You should focus the actual numbers. Those are the numbers that are actually going to give you much more detailed and much more accurate information for your fundamental analysis, especially on year-on-year production, industrial production for the Eurozone, the same thing. Still, there actually we see the slack in the industrial production because we have 0.8% industrial production for the year-on-year numbers. The consensus is 1.1% of an increase, but the previous numbers for the last year was 2.1%. So actually, we have a strong decline in the industrial production for the past 1 year. And of course we had, because there was the particular slack in the economy in the Eurozone, the problems within Greece, the extremely cheaper euro, all of that contributes to more job cuts, and of course industrial production will fall. But in general, we can pretty much see that month-on-month production is going up, so we might be able to see some lift up of the economy. But this is something that you should follow on the calendar every time. You should record this particular data, or if you don't have to, don't want to record it, you can always click on this particular event, see the historical events of this particular release, and you will find out exactly where the economy is heading. This particular thing is not very often made, as to look at exactly one particular industry group, or only the industrial production, or the consumer price index, for example. It's been viewed as in general. So the general idea is to have a look at the GDP, the gross domestic product. This is what will give you, this will give you the estimates of what to expect, where exactly the economy is heading, and whether it's reasonable for you to trade it. So the fundamental analysis, ladies and gentlemen, is focusing on the most certain part of the market, where you see less risk. The less risk you see, of course, the less money you will make. But on the other hand, this is the most certain way. And if you have enough funds into your accounts, you will make substantial profits. Even though if you're trading with one lot and your return is, let's say, 10 pips in 1 month, that wouldn't make much of a difference. That's $100. But if you have $100,000 and if you're trading with 100 lots, now that would make a very good difference. So in general, you will pretty much make, dependingly, if you have something in between $100,000 to $500,000 accounts, you would pretty much make between $10,000 to $50,000 on a monthly basis in such particular moves, in less risky trades. Speaking of risk, it's good to mention that if you guys need anything in particular to risk evaluation or position sizing, so on and so forth, please contact us back so we can help you evaluate your particular current strategy, see where the flaws, and try to give you a few good examples how you can improve that particular strategy, as well as we're all interested in the profits that you are making or you can make. The next particular thing, what we will focus on, without making too much of a noise about the economic calendar, you pretty much got the picture of what you should look for in order to evaluate currency strength in the future. One way is what are the most powerful figures that move the Forex market. Now, of course, on the first place, it stands about the interest rate interest rate change. When I'm speaking about interest rate change, it doesn't matter which direction it goes, whether it's up or down. It only means that, of course, if an interest rate increase occurs, we can expect the local currency to thrive, or to go north, or should we say to go long, or to buy the local currency pair against the other currency that you have evaluated that it's weaker than the one that you're trading at the moment, which, one more time, measuring currency strength at the end of the month. Traditionally, about the interest rates, if a country rises its interest rate, its currency will strengthen, because investors will shift their assets to that particular country to gain higher returns. This is the main focus of all investors when they're looking at interest rates. As well as we're looking at the US interest rate increase, the one that have, for the past 10 years, something like that, have not occurred, or nearly a decade. I think it was about 2006, the last interest rate change. Anyways, the particular interest rate increase will have a major impact over the dollar. It will boost it quite a bit. Of course, that doesn't necessarily mean that in the long run the euro will fall against the dollar. It only means that in particular events like interest rate increase, gradual increase with 25 basis points here, 25 basis points in the next 3 months, the next quarter another 25 basis points. On those particular occasions, yes, the euro will weaken against the dollar, or should we say the dollar will strengthen against the euro. That is a very good opportunity to trade on a day-to-day basis, the particular move. But what you can expect is when this particular interest rate increase occurs, this will have a major impact over other economies, mainly because of the import-export of production. This is one of the main gouges when we're looking at the government budget. And this is also one of the most important topics here. This is the trade balance budget and treasury budget. This is a country that has a significant trade balance deficit will generally have a weak currency, as there will be continuous commercial selling of its currency. So if we have a surplus in the trade balance sheet or the treasury budget or whatever, we can expect the currency to increase, and it's vice versa. So if you have a strong currency, then you can allow yourself to buy a lot of things from countries that have cheaper currency. Then you can sell them, so on and so forth. I don't have to simplify that much for you. I'm pretty sure that you understand my meaning. The next one is the employment situation. Decrease in the payroll employment is considered as a sign of weak economic activity that could eventually lead to lower interest rates, which has negative impact over the currency. So you see, we spoke earlier about the economic calendar, and in general for the fundamental analysis we mentioned the non-farm payrolls. It's the gauge of the central bank for interest rate change. So if they see an improvement in the job market, they will of course look for interest rate increase. And as we mentioned, when we look for long-term trades or long-term fundamental analysis, we should now mention that when we are looking for any kind of interest rate change during that period, you are looking for local currency increase or decrease value. But to give you a better example, interest rate increase in US have already taken the effect over the market. So for the past 1 year, the Federal Reserve was speaking for interest rate increase after they actually that was a couple of months before they've ended their their government purchases of government bonds that they had, the quantitative easing, also called, when they finished it last year. So right after that, the momentum, the strength of the interest rate increase, and the, should we say, the expectation of this particular event is boosting the dollar to its highest levels in almost 13 years. So that's what particular investors and traders are looking for. Somebody to say, we're looking for interest rate change. Not saying if it's an increase or decrease. It's obvious that if you have interest rate increase, the currency will get stronger, and vice versa. So only the rumor is enough for the currency to thrive or slide. At the end, but not the least important, is the gross domestic product. The GDP is reported usually on quarterly basis and is followed very closely, as it is a primary indicator of the strength of the economic activity. High GDP figures is usually followed by expectations of higher interest rates, which is mostly positive for the local currency. So this, all of these particular four events that I've mentioned here, interest rate change, employment situation, trade balance, treasury budget, gross domestic product, all of this is connected to the first one, interest rate change. So that can tell us a very specific thing, that interest rate change is by far the strongest moving force of a local currency. And you can look forward for future price movements of a particular currency. So how do traders are actually using all of this? Well, one thing is absolutely sure, that we need to have our economic calendar at hand. Usually, day by day, we need to follow those news releases, whether we're going to classify them in a piece of, on a sheet of paper, should we say, or on a big whiteboard, where you're inputting every release on month-to-month basis, so you can say, for example, okay, this was a very good month, but comparing to previous releases, past months, we're actually looking for a slight decline in the US or in the economy itself for the next month. So you will also see in the market pricing on when making technical analysis, you will see the connection between those two particular ways of analyzing the market. So we also know what indicator is gaining the most attention at any given time, as it combines a catalyst for future price moves. For example, when the US dollar is weak, traders will watch closely the inflation indicator, of course, the GDP, for future price movement. Another way of how you can use this particular way of analyzing the market is when the difference between the expectations and real results occur, we should watch for corrections in the market price moves. This is what I mentioned when I mentioned about the economic calendar. Over there, I've snuck in a little bit the two ways of trading the news. This is the short-term trading trading strategies that we mentioned on major announcements, with breakouts of support and resistance levels, or with intercandle, or the so-called market correction to enter at a better price and, of course, gain much more profits, as we usually do with our basic particular strategy. So, in general, pay attention to any news revisions, if there are any. The situation on the market can change very quickly, especially when we mentioned the economic calendar is the consensus and its range, because there is a consensus number on a more simplified type of economic calendar, and there is a consensus range in a particular more advanced calendar, which points you in which particular side of the range you are, whether you are to the downside of the range or to the upside of the range. So basically, it's very important to understand all of those points. But as I mentioned, this particular webinar is only in general to show you what we have ahead of us. All of that thing that we actually spoke about for the past 40 minutes now, we will include within the next webinar, where we will also have a look in more details of the key fundamental factors that are moving the market. And of course, not at the last place, I will classify 5 up to 10 different major fundamental factors that you should always have printed out in front of your screen when you have an announcement, let's say from number 1 to number 10, for example. You will see which one has the bigger impact over that particular currency that you're looking at. So don't forget to sign up for our next webinars if you haven't done it so far. And if you have any questions, you're more than welcome to send us an email to webinar@gdmfx.com or directly to our customer support on our website. We have a chat over there. If you don't want to phone us, you can leave your telephone number. We call you back. And for those that are already trading with us, you know how to find me personally to establish one-on-one training sessions. We can trade along if you want to clarify something in addition, or in general, if you want to find out what's the market direction. This is something that we might be able to help you with. Thank you very much for joining us. Don't forget to sign up. Key fundamental factors next Wednesday. Thank you. Bye-bye.